Hi everyone. Thanks for joining this call. We welcome the management of Indiabulls Housing Finance to discuss Q1 results. From the management team, we have Mr. Gagan Banga, who is Vice Chairman, MD and CEO, Mr. Ashwini Huda, Deputy Managing Director, Mr. Sachin Chaudhary, Chief Operating Officer, Mr. Mukesh Garg, who is Chief Financial Officer, Mr. Ashwin Malik, Head Treasury, Mr. Ramnath Shenoy, Head Investor Relations and Analytics, Mr. Harshil Suvankar, Head Markets. I now invite Gagan to share the key details of the results. Over to you, Gagan.
Thank you, Vishal. A very good day to all of you, and I welcome you to the Q1 Fiscal 19 earnings call. Before I get into the numbers, I'm pleased to mention that Forbes, in its Global 2000 list of the largest companies, largest consumer companies, has ranked Indiabulls Housing Finance as the 13th largest consumer finance company globally. We are one of the only two Indian companies on the list. Indiabulls Housing Finance is also now amongst the top 15 dividend-paying companies in India. And continuing with that tradition, I am very pleased to announce that the board has approved an interim dividend of Rs 10 per share. Now, I would request all of you to please keep the earnings update, which we have emailed and uploaded on our website and also on Bloomberg, handy, as we will frequently refer to it. As you're all well aware, this was the quarter of transitioning, so we have successfully transitioned into the new Indian accounting standards, popularly called as Ind AS. All of our systems are geared towards the new norms of accounting. Apart from the slight volatility over the period of time now, from upfronting of sell-down income, the new accounting norms are largely a welcome change as we align ourselves with global accounting standards. Now, getting straight into the numbers, all numbers that we are speaking about, unless specifically referred to, are under Ind AS accounting norms. First, please now refer to slide 6 of the earning update. Our profits for the quarter are at rupees 10.54 billion, up 30% over last year's profits of rupees 8.1 billion. Under Ind AS, owing to fair value accounting of investments, our net worth now stands at 166 billion at the end of June 30, 2018, up from 125.5 billion under IGAP at the end of March 31st, 2018. This is on account of fair value of investment in Oak North Bank, release of deferred tax liabilities on Section 36(1)(a), and other minor adjustments. We've also grown strongly across all key parameters. Our balance sheet at the end of Q1 Fiscal 19 stood at 1.38 trillion, up 29.7% against last year's. Our total assets are at 1.26 trillion, up 33.7% from 944.5 billion at the end of Q1 Fiscal 18. Please now turn to slide 7 of the earnings update, slide 7. Our profit after tax is at 10.54 billion, up 30%. Under Ind AS, in the effective interest rate methodology, which is called EIR, expenses and incomes that are directly related and which can be mapped to individual loans will be subsumed within the loan to compute an effective interest rate. The effective interest rate and the resultant income hence now contains amortized fees netted off for sourcing expenses. Thus, from now on, we will have to report NII, net interest income, inclusive of such fees. However, kindly note this very carefully, however, we will exclude the upfronted sell-down income from net interest income. This is because upfronted gain from assignment of loans is not a reflection of margins in any manner and will be volatile as it is driven by quantum and nature of assets sold in the quarter. The net interest income for Q1 Fiscal 19 grew by 22.1% to over 16.9 billion over Q1 Fiscal 18, where the net interest income was 13.84 billion. This is despite a mark-to-market loss of around rupees 0.5 billion on our liquid investments from GSEC movements, which moved by as much as 50 basis points in the quarter from 7.5% levels to 7.9% levels within the quarter. While upfronting of sell-down income will contribute to some volatility in the income statement, nevertheless, we have adequate buffers in the business to smoothen this amount. You can thus expect predictable profit compounding to continue as it has for the last 10 years, and this is probably the single biggest achievement of Indiabulls Housing. Our net credit costs for Q1 fiscal 18 stood at 0.65 billion versus rupees 1.82 billion last year after the adoption of the new ECL model, and we will delve in detail about the ECL model a little later. Please now turn to slide 8 of the earnings update, where we would provide a reconciliation of the profit after tax for Q1 fiscal 17-18. The EIR adjustment net of effect of assets and liabilities is negative 0.72 billion. This is almost all entirely on account of zero coupon bonds and issue expenses, which were earlier netted off against reserves. The adjustment on account of net gain from assignment transactions for the quarter stood at 0.64 billion rupees. The ECL model resulted in slightly lower provisioning requirement, resulting in a release of 0.09 billion. Tax impact on above and the release of deferred tax liabilities created on Section 3618 reserves led to release of 0.19 billion. Our profits under Ind AS for Q1 fiscal 18 thus stood at 8.1 billion, higher than the rupees 7.88 billion under Indian GAAP. If you now refer to slide 56 of the earnings update, our borrowings stand at rupees 1159.9 billion and net of cash and liquid investments of rupees 185.05 billion. Our net gearing stands at only 5.9 times. This is because our net worth after Ind AS adjustments stands at 164.2 billion. I had mistakenly at the start mentioned this number at 166. Please note that this number is 164.2 billion. Our capital adequacy now stands at 24%. At these levels of gearing, we are back to the levels of mid-fiscal 16 after our last capital raise. Our book value per share now stands at rupees 389 per share. So thus all the questions around an imminent capital raise have been pushed back by a reasonable period of time. On the borrowing side, bank borrowings form now only 32% of our funding mix, down from 35% last year, same quarter. Capital market sources, along with ECBs and sell downs, have contributed to all of our net funding this quarter. Our cash and liquid investments stood at 183.93 billion at the end of Q1 fiscal 19. Please now turn to slide 57. Our spreads on the stock of loans now stands at 323 basis points and is hence at the highest end of our guided range between 300 to 325 basis points. During the previous earnings call in April, I had mentioned that after the rate increase that we had done, our margins would be moving up, and we've ended Q1 despite the move in government securities of as much as 50 basis points at the highest end of our margins at 323 basis points. We've been making the point that as mortgage lending happens at floating rates, housing finance companies can efficiently pass on rate increases in an increasing interest rate cycle and effectively retain their spreads. As a matter of fact, all repo rate increases are a great opportunity to effectively do this transmission. Cost of fund on book basis is at 7.92% and continues to drop as we refinance our stock of loans with finely priced bonds. On an incremental basis, the cost of funds was at 7.88%. We have increased salaried home loan lending rate by 30 basis points and other rates by 50 basis points. And thus, despite the rise in the cost of funds on stock of borrowing, our yield has in fact expanded this quarter, as mentioned earlier, to 323 bips. Spreads on incremental lending have also expanded to 281 bips from 277 bips in Q4 fiscal 18. If you look at slide 57, we've incorporated a new data point there. There is a small, at the left-hand bottom, there is a tabulation of how spreads on stock of loans have sustained despite sourcing incremental loans at a spread of 30 to 40 basis points lower than that of stock-up loans, which has been my point for the longest time now. Each increase in repo rate is an event for passing through the rate increase. Overall, now we are exceedingly well placed on the funding side owing to our upgrade to CRISIL and ICRA AAA. Our cost of spreads to AAA rated housing finance companies, market leader, has compressed by 30 to 35 bips since last year to only about 15 bips since June 17. I would also like to very proudly share another very interesting data. We are one amongst only 5 companies in India, privately owned, which have attained a AAA rating by CRISIL within 20 years of inception. I will now go over the ECL model, which we have on slide 9 of the earnings update. Our approach to provisioning has always been very conservative, and we continue with this conservative approach. We have 99.22% of our assets in stage 1 and 2, and in stage 3 we have rupees 9.8 billion, which is 0.78% of our total loan assets, or thus gross NPA. Stage 1 indicates loans up to 30 days past due. Stage 2 indicates loans between 30 and 90 days past due. And stage 3 indicates all loans which are 90 days plus. We have rupees 3.2 billion of ECL provisions against stage 1 and 2 assets. The experiential loss given default in stage 3 is around 24%, and hence we have provisions of rupees 2.4 billion against stage 3 assets. We have to appreciate that while loss given default historically has been extremely low, these experiential losses and these provisions are an outcome of the fact that you continue to accrue interest in the new Ind AS model on loans which have gone 90 days past due. And these losses also factor in for the time taken for recovery, even though all of these loans are extremely well collateralized. In keeping with our ultra-conservative approach to provisioning, we have retained rupees 10.5 billion of ad hoc provisions over and above ECL provisions of rupees 5.6 billion. The excess provision level will not change, and what is important here is that incremental provisions will only be from the ECL model. So the ad hoc provisions that we have created are one time and will be capped at rupees 10.5 billion. And here on we will continue to follow the ECL model, where our credit costs can be expected to reduce significantly to about 25 basis points from what we were running earlier, which is 70 to 80 basis points. So for the quarter, for 65 billion of 0.65 billion of provisions, the credit costs come in at 20 basis points. For the same quarter last year, provisions were 1.9 billion and were 80 basis points. So this is the state of business. So business will require 20-25 basis points of provisioning going forward. For the past 28 quarters, our NPAs on a gross basis have remained in the range of 70 to 90 basis points. As mentioned earlier, gross NPAs now stand at 78 basis points. If we look at provisioning levels which are specific to stage 3, then net NPAs are 59 basis points. If we look at all the provisions put together, including the ad hoc provisions, we are a zero net NPA company. Moving to more operational aspects, the hardening of interest rates that started in mid-2017 remained considerably stable this quarter, with the 10-year GSEC yields oscillating in the range of 7.5 to 7.9%. Specific to Indiabulls Housing, we have been the unique beneficiary amongst all our peers because of our rating upgrade, which has enabled us to offset most of the macro rise in rates through issuance of low-priced bonds and refinance of our stock of earlier issued bonds. Other levers afforded by a diversified funding profile have also helped us effectively manage our cost of funding. The RBI in April allowed HFCs access to low-cost forex funds through ECBs up to 750 million under an automatic route. In late June, we became the country's first HFC to take advantage of the liberalized ECB guidelines and raised about $240 million from a syndicate of banks from Singapore, Korea, Japan, and Taiwan. We also refinanced our existing erstwhile ECBs of $350 million, saving over 50 bips. And now we have over 25 international lenders from countries such as Taiwan, Singapore, Korea, Japan, Dubai, and London, and the United Kingdom. As intimated previously, IBHFL has established an MTN program of up to USD 1.5 billion on the Singapore Stock Exchange, which enables us to issue masala as well as dollar bonds and on tap. We hope to tap into these long-term dollar debt markets regularly and raise at least $1 billion annually. We are also developing the ECB and the masala bond market for ourselves and continue with the practice of diversifying our sources of financing. Cost-efficient portfolio securitization also came in strong in this quarter, with Indiabulls Housing clocking over 25 billion of pool sell-downs in Q1 fiscal 19, up over 25% over Q1 fiscal 18, where we had sold down around 20.5 billion. This increases our funding efficiencies, increases return on equity, and we continue to use whatever diversification method products we get. We also continue to use swaps efficiently to both reduce our costs as well as hedge all market risks. We've just concluded our largest operating quarter in our lifetime. And on this note, I cannot be more optimistic for Indiabulls Housing Finance prospects and for the whole housing sector. And I feel that over the next 5 to 10 years, we will continue to compound on the basis that we have compounded over the last 10 years. On this upbeat note, we are now all open for questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star 1 now. We have a first question from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah, congratulations. Good set of numbers. So, firstly, under this Ind AS, how has the net worth, particularly the opening net worth as of 1st of April, that has got restated? And even if you can just share in terms of the FY18 numbers, okay, wherein there was like, say, 9,000 crores. So, how is that becoming, what is that number under Ind AS?
Yeah, so, just before we answer these net worth and balance sheet related questions, answers are all subject to the fact that we haven't yet undergone an audit, and therefore these are as accurate as estimates as we can get at this time. With that caveat, my colleague Ashwini will just run you through these numbers.
Sure. Yes, so if we talk about April 2007, where the cumulative impact of transition of March 17, the impact on balance sheet is there. The difference is around 3%. We had under Ind AS net worth of 12,125 crore or 121 odd billion rupees, which has increased to 124.7 billion rupees. So there's a difference of 3%. Largely, the most of the impact has come through release of deferred tax liabilities. Whatever was, 1.5 billion of effective interest rate negative has been made up by positive on securitization upfront of income of around 3 billion. And hence the net effect of DTL is what is reflecting in the higher net worth of by 3% to 124.7 billion.
And in March 18, it is largely on account of both deferred tax liabilities as well as revaluation of our stake on the back of the capital raise that Oak North Bank had done, and then subsequently we sold our stake to GIC, and then there was another $70 million transaction which was done. So basis all of these external transactions, Oak North Bank's revaluation has contributed to the balance increase in our net worth.
So this Oak North, now it is at the fair value rather than at the cost?
That's correct.
Okay, and that was not in FY17, but that has happened in FY18? Or maybe
FY17, there was an insignificant change in Oak North's valuation that we had done. In FY18, because there were third-party transactions, including the stake sale that we did, we had an accurate benchmark to revalue. And here on, there are now, Oak North has many external shareholders besides Indiabulls Housing, which are very large funds. So on that basis, the valuation, whenever there is a third-party transaction, will move up or down.
Okay. And in terms of earnings, last time 3,800 crores of a PAT. So now what was the restated number?
So we've restated it for the quarter, and we've compiled it for you and given it for the full year, etc. We are going to put up those numbers in a few days.
Okay. And in terms of the disbursements, maybe the disbursements under Ind AS has also changed, and this cumulative, is it under Ind AS, what we share it in the operating metrics?
No, disbursements under Ind AS don't change. Disbursements under Ind AS are the same.
So this, so this number which is there in terms of disbursements, so what is the disbursements in this particular quarter?
Yeah, I'll tell you. One sec. So disbursements stand at how much? 10,000. We've disbursed 10,044 crores this quarter.
10,044.
Yeah.
Okay. Okay, cool. And the breakup between the home loan mortgage, maybe home loan LAP and the non-individual book?
So around 5,600 crores of home loans, 1,500 crores of LAP, and around 3,000 crores of commercial loans split between construction finance and lease rent discounting. The two trends which I forgot to mention in my earlier remarks. One is that the home loan space, which is the mid-income group space, is seeing reasonably good traction, and the competition remains absolutely benign. And therefore, there is good traction that we are continuing to see there. And now, subsequent to RERA and GST having settled, both of those, for different reasons, which we've spoken about in the past, are causing a tremendous consolidation in the residential construction space, and therefore a fairly large demand from good, high-quality developers. So that product is also seeing extremely good traction.
Okay. So why last time in terms of cumulative loans disbursed, it was 1.97 trillion, and now it is becoming almost 2.25 trillion. So I think that number was coming to almost 200 billion, okay, which was quite surprising. So I don't know why that is happening. If you look at Q4 FY18, cumulative loans disbursed till date, okay, that was 1.97 trillion.
Right.
And today when we look at it in this presentation, it is 2.25 trillion. So that suggests in this quarter, we would have done almost like 280 odd billion kind of a disbursements, which seems to be much.
I can check that, but the number, I can check.
But the number is, any which ways is 100 odd billion, yeah.
Yeah, that number is 100 odd billion. I can check what is this and get it rectified.
Oh, okay. Okay. Yeah. Thanks a lot.
Thank you, sir. We have a next question from the line of Viral Shah from Credit Suisse. Please go ahead.
Hi, good evening. Sunil Tirumalai from Credit Suisse. Thank you for your opportunity. I have a few questions, again, going back to the transition. And if you could explain to me, if I look at last quarter's, March quarter's presentation, I think you were carrying total provisions of about 17.6 billion, whereas now you're carrying only 16.1 billion. So it's actually fallen. I just want to understand what happened.
We were carrying provisions of?
So last quarter, slide 26, 8.92 regulatory plus 8.66 extra. That's 17.6. Whereas now if I add the three buckets of, stage 1, 2, stage 3 and your ad hoc, it comes to 16.1. So that's some 140 crores lower provisioning total this time.
So there would be some release of provisions which would have happened, which will happen through the course of the next 3 quarters. So you will see a release of provisions of around the balancing number, which you see as a gap. So there would be some adjustments that we would have done in the net worth and some other adjustments that we will have to do, which will be relatively minor in nature, which we will have to do over the course of the next 3 quarters. So the 150 crores that you're talking about will happen over the course of the next 3 quarters.
Okay, so there will be 150 crore more of release in the next 3 quarters.
Yes.
Okay, understood.
In that ballpark, I could be wrong by a little bit, but in that broad ballpark, there will be a further release over the next 3 quarters.
Right. And you mentioned ad hoc of 10.5 is where it is, and going forward, it's going to be just driven by the ECL PD LGD model. That's
right. So which we expect to be in the range of 20 to 25 bips of assets.
Right. But if you had the freedom to create or make this 10.5 billion ad hoc stock, why not also create, ad hoc, recurring, on a running provisions as well every quarter?
No, we actually, for our ECL model, we actually engaged a couple of consultants, including Deloitte and Experian, etc. And we've been able to create these ad hoc provisions basis the macroeconomic factors, which have moved from, over the last 2 years, from demonetization to a potential rate increase environment. And because the macro has been evolving very rapidly and the country has seen significant events which are almost like a once-in-a-lifetime kind of events, especially as the country adopted and went through demonetization and then went through GST, etc., our consultants have allowed us to create these provisions. On an ongoing basis, there is no provision which you can create on a micro basis. So unless there is some big macro event, there would be no scope of creating ad hoc provisions, and micro provisions will have to move basis the ECL thrown up numbers. So as I understand, what would happen is that as the stock of our home loans increases and the granularity of the book continues to increase, since you will appreciate, having heard so many NBFCs now, that each product has its own ECL model, the loss given default and the probability of default of a home loan is the lowest amongst the 4 products that we have. And therefore, what is currently 20 basis points will trend, 20-25 basis points will trend even lower. So that's the nature of ECL. So ad hoc will not be allowed. We will have only these ECL provisions, which will be in the range of 20 to 25 bips, trending lower as home loan proportion increases. So the requirement of business under ECL is 20 basis points and is not the historical 70, 80, 90 basis points that we used to create.
Right. So basically your earlier philosophy of actively, consciously creating extra provisions, that wouldn't work anymore.
That's correct. So we will not be able to create those extra provisions. So we will have to look at, other ways of being able to create buffers around expenses and investments in all of that to be able to create some buffers. But creating buffers through loan loss provisions is not going to be feasible anymore.
Right. Unlike your usual slide deck, the last couple of slides on the consol balance sheet and income statement was missing this time. So that's something that...
It will have to be missing because the balance sheet, etc., have to be reviewed by auditors, and you will appreciate that in this transitionary phase, there is only so much that we can put out in writing, and it is always very difficult to restate any number. We've also put up, right at the start, the fact that some of these numbers may change a little bit, because especially the balance sheet related numbers by a little bit, but that's just being on the safe side. We've tried to most accurately estimate everything, and they've been reviewed by two different set of eyes, external eyes. So I'm quite confident, but it's difficult to put up these numbers. As far as P&L, etc. is concerned, whatever exchange filings are required, we've done that, and they would be up on our website as well as the exchange website from a P&L point of view.
Got it. And, under the Ind AS reporting, your NII would include, your yield on investment.
The unamortized fee that we have will not include securitization. Securitization number will be reported separately, and while it will impact the profit for the quarter, and thus we will have to create an impact for that when we are giving out our guidance, etc. But it will vary depending on how much we sell and what proportion of assets we sell between priority and non-priority loans and between home loans and LAP. The spread range is quite different, and so is the time and the securitization model, the upfronting model for each loan that we have. So given that, there could be a reasonable degree of volatility, but fortunately those numbers are such that for a company reporting profit before tax of 1,400 crores, it will be like a 1 to 2% kind of impact item, but it will have a greater impact on the net interest income compounding number. And what most stakeholders tend to view net interest income is more a reflection of where margins are, and it is not going to be a true reflection of margin in any manner. So net interest income will not carry securitization. All loans that we do generate some sort of a fee income. Unlike a bank, we do not have any fee income which cannot be attributable to a certain loan and a loan account number. And therefore, fee income can now be, especially since it's not being upfronted, can be attributed. It will be spread over the life of the loan, and therefore will be a steady NII item. Securitization will not.
And sorry, the yield on your investments?
Yield on investments was always part of NII and will continue to be part of NII.
Okay, understood. Thank you. Thank you very much, sir.
Thank you. We have a next question from the line of Adarsh from Nomura Securities. Please go ahead.
Hi, Vivin team. Thanks for taking my question. On the net worth impact, I just wanted to understand the increase that you had after the revaluation of Oak North. In regulatory terms, does that's allowed to be carried as Tier 1?
Yes, to the best of my knowledge, and whatever exchange we've had with the National Housing Bank, the National Housing Bank has told us that this will be part of core Tier 1, will be part of our capital adequacy, which stands at 24%. And the only thing that we need to report separately to Reserve Bank, to the National Housing Bank, and for our subsidiary Indiabulls Commercial Credit to Reserve Bank of India, is NPA as it is on 90 days past due basis, and the provisioning which is required against that, and where is our provisioning there. We are grossly over-provided. We our standard provisions of roughly 1.3% of balance sheet, and therefore there is no issue on that. Apart from that, whatever Ind AS allows, the regulator has allowed, and therefore this is part of core Tier 1 and brings up the capital adequacy.
Perfect. Thanks, Kiran. The second question was relating to the slide number 8. You kind of show the movement from gap to Ind AS. I just wanted to understand the 72 crore negative is obviously on the EIR, and that 64 crores number, right? Is that the upfronted income on assignment? Is the 64 crores was the upfronted income in 1Q assignment? Is that the way I read these numbers?
Others, there is a slight adjustment as well. Ramnath here, because in Indian GAAP, I would already be accruing the spread earlier for the quarter. So this adjustment is net of that spread accrual. So some of that spread will get reversed and will get upfronted.
So this is the net upfronting that you would have done, right? Correct?
Yeah. So the actual upfronting for the quarter would be higher than this. Netted off against the reversal that I have to do, it would be 64.
So every quarter will see some positive from whatever we will upfront, whatever we will sell down in that quarter, and it will be netted off with some negative which will be coming from the previous quarter, and therefore the number that you will see, which in this case is 64 crores, is an net number of that upfronting and the negative.
So if I use 1Q as a trend, Gagan and Ramnath, is it safe to assume the recurring NII is lower by 72 crore and then the 64 crore will vary depending upon the sale you will do? Is that a fair assessment of, if I extrapolate this number, is that the way I look at the numbers?
So are you talking about the rest of the year?
Yeah, I'm just saying if I assume this to be more a recurring pattern or if I can do that.
So going forward, there won't be any concept of zero coupon bond. Everything is going under Ind AS through the P&L. So there won't be this negative going forward if that's what we are talking in the long term. So it is only for the previous year because the zero coupon bond interest did not flow through P&L. Is there a negative item there?
And all of it relates to the zero coupon only? No, there will be other adjustments there, right, in that 72 crore?
Largely, we have to talk about 90% of of any item. 90% of the item is zero coupon.
Okay, understood. That's helpful. Next question on the cost of funds, right? We report a cost of fund on book basis of 792. If you can just give me the cost of fund broken by instruments, because that's a very good cost of fund, or pretty low. So I just wanted to understand, the MCLR is higher than this. A AAA institution would borrow higher than this. So if you can just give me the breakup of your, the various liabilities that add up to 792 on a weighted basis.
Others, we are also at AAA.
Yeah, absolutely. So
when you say that AAA would borrow lower, then we are right.
No, AAA would borrow higher. I meant like given the rates today, right? So I was just trying to match this vis-a-vis, what rates.
These are rates which are all on monthly basis, and we have to report all of our bond borrowings for the last year plus on the stock exchanges. So these would all tally back to whatever you will see there, where rates would generally be annualized. On banks, we borrow at about 8.05%. The marginal saving that we get here over what you would simply see as MCLRs would be that we have a fair amount, almost over a third of our borrowings from banks in the FCL route, which allows us to borrow at least 30-35 basis points cheaper than what we would borrow net of the swap that we would borrow if we were doing just pure rupee term borrowing. Then we have bonds and securities which are blended for NCDs and CPs, and these are monthly rates. And then we would also be doing some swapping here to convert some of these fixed rate borrowings to floating rate borrowings. Given the fact that GSEC had moved up from 668 to 780, 790, but repo has only now gone up twice, there is a fair degree of spread and saving that you can do when you convert your fixed into floating, and that swapping we actively do. Our ECBs are at about 7.55%. Sell downs blended for both priority sector and non-priority sector are at about 7.6%, and that's how we get 7.92. On an incremental basis, our term loans come to us at just over 8.1%. Our bonds come to us at 8.2%. CPs at 7.35. External commercial borrowings at 7.55. And sell downs in the same handle to get us at 7.88% or so of incremental borrowings.
Perfect, again, and thanks for this. And the last question is on the insurance sale, right, the credit protect sale. Is that, that income has to be amortized, or it still is an upfront booking that is allowed under INDS?
Oh, so that income is not to be amortized. It's a one-time income, and therefore it's taken. And we don't only sell the credit product, protect product. We have live active arrangements with for life, non-life, as well as health products. And whatever commission we get, it is sold to our existing customers, and therefore, and in some ways linked to a loan, and helps us cover the risk of the loan, either by covering the property or the life of the loan, life of the borrower. So, but that income can be taken upfront.
Perfect. Thanks a lot for all this, Gagan, and congrats again on a great set of numbers. Thank you.
Thank you. Thank you.
Thank you. So we have a next question from the line of Pooja Ahuja from Equentis Wealth. Please go ahead.
Yeah, hi. Thanks for taking my question. So my question is, in your mortgage loans, what would be the breakup between home loans and LAP?
Okay, home loans are roughly 60% of the book, and LAP will be roughly 19% of the book.
This is the total book?
Yes.
Okay. And sir, how much would be the smart city loans of the home loans?
Would be now about 20% of all loans, of home loans.
Okay. And so all of these smart city loans are e-home loans, right? Through the e-home loan platform?
No. That's a different platform. So the e-home loans will be contributing roughly a fourth of our incremental business, 25-26%. Smart city loans are the loans that we do in locations which are more like tier 3, tier 4 kind of locations, which is an initiative which we started about 2 years ago. And on an incremental basis, it contributes to about 20% of business.
Okay. All right. Thank you, sir.
Thank you. We have a next question from the line of Umang Shah from HSBC. Please go ahead.
Yeah, hi. All my questions have been answered. Thanks and wish you all the best.
Thank you, Umang.
Thank you, sir. We have a next question from the line of Rakesh Jain from Jasper Capital. Please go ahead.
Hi. I just wanted to understand your segmental leads, like for home loans, CF, affordable housing and all. Is there any pressure you felt during the quarter?
No, the spreads talk for themselves. So the spreads are inched up. At the end of March, the spread stood at 311 basis points, which has increased to 323 basis points. So we are there is no pressure. The market has already and we along with the market have already done at least 2 transmissions between March and April. Some banks have, in anticipation of yesterday's RBI policy, have already increased their MCLRs. I expect most banks to recalibrate MCLRs between the month of July and August. And if not all, most of the repo will get transmitted. And we will follow suit. So we will also do another round of transmission over the next few days as soon as the ALCO meets. As far as yields are concerned, on an incremental basis, home loans are fetching us now 9.25%, which used to be 8.9% last quarter on incremental basis. LAP loans are getting us 11.65%. Up from 11.15% last quarter, and commercial loans are getting us 12.86%, up from 12.35% on incremental loans last quarter. So more or less the transmission, even on new loans, has been efficiently done to the extent that the back loans have been repriced.
Okay. And maybe the GNPA, maybe in the construction commercial finance, means the construction finance book, GNPA is over there.
Yeah, gross NPA is 2.12% are gross NPAs in the commercial loan book.
Okay, thanks a lot.
Thank you, sir. We have a next question from the line of Amit Jain from Samsung Asset Management. Please go ahead.
Yeah, hi. Thanks for taking my question. Just wanted to understand this Ind AS again.
So this 470 million that we sort of see for this year's sort of sell down, that's again a net number like 640, or that's only the excess interest spread that's been upfronted?
Which one? What? This 47 billion. Are you referring to slide 7, the 47 billion?
Yeah.
That's only the
40 million. Yeah.
That's related.
So again, in this, there is no reversal of previous year, like the net number that you have for like slide.
There would be a reversal because that entire rounding off has happened as of March 17. So everything after March 17 will have a negative and a positive.
So there will be some negative.
Yeah.
Okay. And this one is again like you only take the sort of the way it works is you take the interest spread which is there sort of up and upfronted, and there are no costs related which are sort of mark to market as well, or that's not done?
There would be. So we would have the spread which will, basis some assumptions of the life of the loan, there would be the net present value of that, and then there would be some cost, servicing cost, which would vary between different types of loans and the value of the loans, which will reduce it, and then there would be a reduction happening because of the past quarter flows. Net of all these three would the final number emerge.
Perfect. Thanks.
Thank you, sir. We have next question from the line of Manish Ostwal from Nirmal Bang Securities.
Yes, sir. Thank you for the opportunity. My question on this, your incremental spread thing, you said it is 277 to 281 in this quarter.
Yeah.
Whereas our average spread is 323. So the way one should look at it, your incremental spread will create further pressure to your average spread?
Sir, I would refer you to slide 57 of our earning update.
Yes.
So if you look at the bottom part of the table there, of the page there is a table there which talks about trend of spread in stock of loans and incremental loans. And if you see the trend ever since the early to mid last year, SEC in March 17 used to be, and as we speak it stands in the handle of 780, 790. The constant in our business is that the spread on stock of loans has remained around 320-25 levels, and spread on incremental loans has remained in the range of 275 to 80 basis levels. So as both of these blend, intuitively the rates, the spread should be going down. But what you see is that the difference, which is spread on stock of loans and spread on incremental loans, A minus B, has stood stable at 42 basis points. And our spread on stock of loans has not declined despite this pressure of 40-42 basis points, because you continue to pass on rate hikes on the back book. So if you see our cost of funds have moved down between June 17 at 8.25 to June 18, 792. Between March and June, they would have moved up by about 12 basis points. Against a 12 basis points increase in our cost of funds, we've already done a transmission which is in the handle of 30 to 50 basis points depending on the product. So because on the whole back book, so the stock of our borrowings went up by 12 bips, but the yield on our lending went up by between 30 and 50 bips. So in any interest rate rising environment, whatever is the discount that you're typically doing, which is an industry practice in India, tends to get booked at a higher price because of effective transmission. So, and I've been trying to point to the same industry fact for the longest time now. So there is no pressure on rates, and opportunity comes whenever RBI will hike repo. So yesterday's repo takes a little bit of difficulty to do a transmission just on the basis of increase in government securities. But if RBI hikes, then the market expects, as you would have read to this morning's newspaper, that home loans and all loans will become more expensive. I hope I have answered your question.
Yeah, it's quite helpful, sir. The second question I have was on the growth side. I attended a couple of real estate companies' concall to assess the demand outlook in the market. And the new projects still very muted in terms of launches, and the inventory is still very high in the key markets. So in terms of growth, where we are seeing growth in terms of top cities or tier 3 city or tier 4 city, we are seeing higher growth compared to the larger city. And in second, in terms of price points, which price point is the highest growth we are anticipating or we are seeing in our business?
So most of these listed companies, again, as we've been highlighting in the past, continue to transition, but in the past have been largely focused on more premium housing, which is not an area of interest for us. The mid-income group housing is the area of interest for us over the last 10 years and continues to remain area of interest. From various reports that we have been reading over the past few months, and we put out all of those statistics in the macro section of the earning update. Launches in the mid-income group housing are up between 40 to 70% year on year across all the suburbs of the large cities. And those large cities continue to be where massive and maximum job creation is happening. So tier 1 locations continue to be an area of focus. That said, now with GST having stabilized, there is a great market also in tier 2, tier 3 locations where assessment of credit has become a lot more easier, and therefore those are also gaining in traction, as is reflected in the business volumes that we are clocking in our Smart City program. So you will get a better idea of how launches are rapidly happening if you look at not these large listed real estate companies, but more the mid-sized real estate companies. Or if you visit the suburbs of large cities, such as if you visit Virar, Vasai, Panvel, etc., in the outskirts of Bombay, then you will see. If you just go back 3 to 4 weeks, the Chief Minister of Maharashtra, for a mid-sized developer, Vatva developers, had done an inauguration of in Panvel on a project which is spread over 100 acres. And I think the total area under development is something like 3 crore square feet. So that's the quantum of affordable housing development being done by just one mid-sized developer of Mumbai.
Understood, sir. And the last point I have, on the LAP side, other banks have commented on the asset quality issues in the LAP and the not a right valuation happening in the segment. So, how we are seeing our portfolio behaving in the in loan against property, and secondly, have we increased our underwriting standards up to factor the incremental risk?
There are 3 points from whatever I have read in the market. The concern is more about how collateral of SMEs is being valued, and that need not necessarily be collateral which is residential property. Valuing residential property is a lot easier to valuing plant and machinery, goods lying in godowns, as well as industrial property, which is what the banking system generally does. When it gives out these 4, 5, 10 crore loans, it rarely takes residential property. Most small businessmen will not have residential property worth the value of collateralizing such a large loan. they would generally be able to borrow money in a few lakh of rupees or maybe a crore, crore and a half. They will not be able to support a 5 to 10 crore rupee valuation, which is required when they're doing borrowing from banks traditionally. So that's what's been alluded to rather than residential valuation. Residential valuation is, generally speaking, reasonably straightforward. As a country, this whole question around valuation and property prices, etc., has been going around now for nearly 2 years, and it came to a lot of discussion in the period around demonetization. And today what we see is, as users, when we go out there to try and find a house for ourselves, there is no property price correction which has happened in at least house property in most locations, catering to mid-income type of houses. Super premium, there could have been some correction. So in that context, the business that Indiabulls Housing does is roughly a 70 lakh rupee house against 70 lakh rupee loan against a property which is valued at about 1.5 crores. Not so very difficult to value. Our regulator requires 2 valuations, one internal and one external, for anything that we value above a crore. So we get 2 benchmarks. We have developed a reasonably large and sophisticated technical team over the last 10 years, which does these evaluations quite accurately. So we are not depending on third-party valuers, which is again what was being alluded to in the discussions around valuations, that there are no good high-quality third-party valuers which are there. And lastly, for the last 3 years now, we have adopted this practice of getting every loan against property loan. Each loan of 70 lakh rupees then gets subjected to a scrutiny by our rating agencies, and which also publish a report which we then publish for you every quarter. Since we actively sell down our loans, we also publish static information, and probably we are the only guys in the industry doing so now for over 3 years, which reflects the health of our home loan and our loan against property portfolio on a static basis over the last 3 to 4 years. So on the basis of all of this data, which is in front of both you and me, I am reasonably confident that neither is there a valuation challenge, nor is there a portfolio quality challenge. As a matter of fact, the management team here is convinced that with the advent of GST and with GST now stabilizing, lending to the self-employed is perhaps the single biggest lending opportunity which exists in India on a very, very scalable basis over the next 10 years. And the fact that we have expertise and experience of having done that for the last 13 years, I would say it is one of the largest growth opportunities in front of Indiabulls Housing, which we are actively pursuing. So our stand is actually the opposite. We are very comfortable and extremely confident of this segment of lending.
Sure, sir. Thank you so much and all the best.
Thank you.
Thank you. We have a next question from the line of Manish Agarwal from Phillip Capital. Please go ahead.
Yeah, congratulations and thanks for the opportunity. Can you share your experience in terms of prepayment, especially in the last 6 months?
The prepayments are holding pretty steady. So home loan prepayments are at around 0.9% amortization, which is reasonably steady. Around 1% levels, which is reasonably steady. For the full fiscal 18, it was at about 0.75%. So, prepayment rates are okay. We have over the last 8 years been benchmarking our pricing to the largest lenders in the home loan space. We've also made sure that our reference rates is in step with all of these large lenders. So therefore, neither the back book nor the incremental book is ever mispriced in that sense. And the team very actively operates, making sure that we have the highest level of efficiency. Thanks to the focus of the team, we actually saw quarter 4 is generally when the maximum pressure comes. Actually saw the lowest quarter because the team scaled up and took it as a challenge. So I would say fine as far as payments or other loans are good. There is a natural expectation of prepayments in the larger loans, which is also in line with what our expectation is.
Okay. And next question is about the ACL calculations. So how many years data generally is used in this calculation? And I guess this is rolling in nature, correct? The period of data.
We have our own data related to retail loans now for 13 years. We've also relied on external consultants such as Deloitte, etc., to help us, and used various data which is available with the credit bureaus of the country. And use their help to create all these provisions and models. So with 13 years of our own data, we got 90% of the relevant data points, and the balance 10% have been supplemented through third parties.
And finally, out of, you mentioned about 20-25 basis point kind of credit cost going ahead.
I would also like to add, in quarter 4, we'd also spoken about the entire, creation of the ecosystem and how we are working hard on decisioning in an automated manner. So all of that actually presupposes all of these risks. So for every loan that we do, we already have a reasonably well-established decisioning model, which actually allocates the risk around that loan and helps us price that. So we have not only been, we did not only have access to data which was, the actual loan loss data. It is being put into practice on decisioning for the last year and a half, ever since we launched our e-home loan platform. So on all of these flows, we've only been extremely conservative as we have been on provisioning in the past.
Okay. Finally, can you give some sense about the ACL product-wise, maybe home loan, LAP, and your construction finance for the stage 3?
Yeah, it will come to a ballpark of 25% of stage 3 assets and will tend to go slightly lower over a period of time. Currently, as we speak, it will be in the ballpark of 25% cutting across assets. On commercial, it's very difficult for us to give you this breakup because a large contribution to stage 3 happens through commercial loans, and each commercial loan has to be independently valued on cash flow basis to arrive at the expected credit loss and the loss given default, especially given the fact that all of our loans are over-collateralized. So all we are trying to estimate is the time to recovery, which gets us to the expected credit loss. So in that background, the 25% number is rather conservative. And I hope that over a period of time it will also move lower. But as we speak, and as I've been mentioning in the past, we've chosen to be slightly conservative.
Okay. Thanks and all the best, Gagan.
Thank you.
Thank you. We have a next question from the line of Subramanian Iyer from Morgan Stanley. Please go ahead.
Hi, Gagan. Thanks for the opportunity. One data point question basically. So what proportion of your borrowings is commercial paper on both a stock and incremental basis, and what is the average tenor of your NCD book?
So the average tenor of the NCD book will be around 3.5 years. Commercial paper will be outstanding, will be about around 9 to 10% of our overall borrowings. What we've been able to do in that commercial paper is elongate the length of the commercial paper, so which used to be 3.5 months earlier. Now it has been elongated to almost 8 months. So it's a reasonable duration product as against in the middle we had dropped it down because there was no money available longer than 3.5 months. Now we've been able to elongate to almost 8 months. So we are comfortable at these levels.
Thanks. And can you split your incremental yield on home loans into on an approximate basis into salaried home loans and self-employed home loans, the 9.25%?
As a thumb rule, salaried self-employed home loans will get you about 100 bips higher and would be about 30% of the book.
Got it. And finally, the increase in net worth on account of the revaluation is approximately 3,000 crores. Just wanted to get a sense.
Will be about 2,500 crores.
Thank you.
Thank you, sir. We have a last question from the line of Deepinder Bhatia from Bayard Asset Management. Please go ahead.
Gagan, just a couple of quick questions on the balance sheet and leverage. You touched on at the start of the call that as a result of the change in the total equity due to the reval, you have more flexibility as to when to raise additional capital. I was just wondering that is that sort of the key metric, or given that that's really an accounting adjustment, or are cash-on-cash ratios equally important, and what is your thinking in terms of the actual timing for any further capital increase? So that's the first question. And the second, I'll just sort of interconnected to that. I noticed that, you did increase the dividend this quarter, but I think the payout ratio is somewhat lower than we had clocked last year. So I was just wondering about that also. Thank you.
So our, long-standing, I'll do the second before I come to the first, because in some ways the second leads to the first. The long-standing dividend payout policy of the company has been 50% of profits. Over the years, the regulators have been giving risk weight breaks, which have caused about 3-4 years ago a big reduction in our overall capital requirement for the business, and we had accelerated the dividend payout. For 2+ years, we held it at a certain 9 rupees per share per quarter, and from the last quarter, we started increasing it, given the increase in EPS. Our dividend policy stays the same. Unfortunately, over the years, the government has also imposed a dividend distribution tax. So the policy is 50% of profits come the dividend distribution tax, and we will try and stick to this for as long as possible. And that is where we get to $10 for the current quarter. So there is no change in our dividend distribution policy. As far as gearing, as far as capital raise and etc. is concerned, it's eventually an outcome of both capital adequacy and gearing. Gearing is down to 5.9 times, and which is around the same levels that we had raised capital. If I recollect, after the capital raise, we were at about 5.4, 5.5 times when we had raised capital. So we are at those kind of gearing levels. We will continue to stay engaged with all stakeholders. The most important, as far as this is concerned, is rating agencies. But from the preliminary read of this, we have an opportunity both from securitization as well as these accounting standards to be able to maximize return on equity and yet run at a reasonably robust capital adequacy, which stands at a ballpark of 24% as we speak. So in that context, any imminent capital raise is off the table. But yes, we are, as a responsible company, we have to continue to stay engaged with all stakeholders, and we shall do so. And if there is any plan, we will obviously come back to you.
Gagan, congratulations to you and your team on a really solid quarter in pretty volatile markets. So congratulations and good luck for the rest of the year.
Thank you for your support as always and for your kind words. Thank you. So thank you, everyone. A good, solid quarter and great opportunity. The largest quarter for the company. I think we've laid a good foundation by successfully and smoothly transitioning to Ind AS without causing any big change in any of the numbers. We were ourselves quite concerned when we got to know in the middle of the quarter that we have to rapidly transition. But the team has done extremely well. So thank you again, everyone, for your support, and look forward to speaking with you in about 3 months. Thanks.